The great investor does not crave certainty. She understands that markets are a probabilistic arena, not a deterministic one. Outcomes are messy, expectations fluid, and returns often asymmetrical. Thinking in terms of probabilities is not optional in investing. It is the operating system itself. Like a skilled poker player or a successful general manager in professional sports, great investors seek edge where others see noise, relying not on clairvoyance, but on expected value. This video explores why thinking in probabilities is a core trait of elite investors. It examines how this mindset shifts focus from outcomes to processes, rewards slugging over batting average, and applies a disciplined approach to modeling uncertainty in a world rich with unknowable outcomes. Investing is rarely about absolutes. Instead, it is about the weight of evidence, competing narratives, and expected values. Great investors are constantly seeking an edge, a misalignment between the market-implied probability of an outcome and their own estimate, coupled with a favorable payoff if their view proves correct. This is not unlike a professional bettor spotting that a sportsbook has underpriced a team's odds. The investor's version of this mispricing might be a growth company trading as if its margins will deteriorate sharply, despite robust structural tailwinds. In both cases, the edge lies in spotting a distorted price, not in being certain of the outcome. One of the hardest psychological adjustments for investors is accepting that good decisions can result in poor outcomes, and bad decisions can sometimes be rewarded. This is the nature of probabilistic fields. In the short run, randomness often dominates. The antidote to this cognitive dissonance is to focus on the decision-making process itself. Consider the investment committee that rejected a biotech stock which later doubled. If their rationale was sound, perhaps based on clinical trial uncertainty or weak cash burn discipline, the outcome does not invalidate their logic. Over time, good decisions should yield good results, but sampling variance means even the best investors lose often. Legendary investor Howard Marks puts it best: you can't judge the quality of a decision by the outcome. Investors often confuse being frequently right, batting average, with making a lot of money, slugging percentage. The two are not the same. The batting average investor might score lots of small wins, but fail to capitalize on the few game-changing opportunities. In contrast, the slugger is often prepared to be wrong, knowing that the payoff is massive when they're right. Consider Nvidia's 2023 Ascent amid the AI boom. Many missed the trade because they dismissed the hype cycle or preferred higher batting average bets. But the slugger who recognized the asymmetric upside of generative AI exposure and managed position sizing could have reaped extraordinary gains. The lesson: it's not how often you're right, but how much you make when you are. Loss aversion, however, trips up even sophisticated investors. Nobel laureates Kahneman and Tversky demonstrated that losses hurt twice as much as equivalent gains feel good. This bias leads to risk-avoidant behavior and premature selling of winners. Overcoming this psychological hurdle is essential for anyone aiming to boost their slugging percentage. Probability estimation in investing typically takes one of three forms. Subjective probability is based on belief. For instance, estimating the chance of China invading Taiwan within the next 5 years requires geopolitical insight and interpretive reasoning. Propensity probability derives from structural properties, like the odds of a structured product defaulting under specified credit stress conditions. Frequency-based probability looks at historical distributions. This is often the most practical for investors, particularly in forecasting sales growth or earnings volatility across sectors. Want to estimate a SaaS company's CAC to LTV ratio? Look at the base rates for comparable firms. The best investors blend all three methods, anchoring on frequency data, updating subjectively as new information arrives, and incorporating structural realities. Bayesian updating, a framework for adjusting beliefs in light of new data, is a vital tool for such thinkers. We've identified 3 market scenarios that could illustrate the benefits of probabilistic thinking. In 2014, Amazon doubled down on AWS, its cloud infrastructure business. At the time, AWS was unprofitable and opaque. Sell-side models largely ignored it. Bezos and team saw a skewed payoff. If cloud computing became essential, they would dominate a high-margin industry. Today, AWS is a $90 billion plus revenue behemoth. Amazon didn't need high batting average predictions, just one extraordinary slug. In early 2020, Pershing Square's Bill Ackman spent $27 million on CDS protection, betting that credit spreads would blow out as COVID shut down global economies. The bet returned $2.6 billion. It was a rare positive black swan, massive payoff, limited capital at risk, and a clear asymmetry. Crucially, the idea wasn't about being certain. It was about expected value. Archegos Capital Management imploded in 2021 after over-leveraging via total return swaps on a handful of volatile stocks. The firm's strategy relied on high conviction and apparent probability, but it ignored frequency-based data and failed to manage downside scenarios. A reminder, when you ignore variance and tail risk, the outcome can be ruinous, even if you're right for a while. In some domains, probabilities and outcomes are both opaque. These are the black swan territories that Nassim Taleb described, unforeseen, impactful events rationalized only in hindsight. While prediction is impossible here, participation is not. The investor's task is to be positively exposed. Venture capital does this well, backing a dozen startups with the expectation that one will return the entire fund. Biotech investing often mirrors this structure, numerous failures punctuated by a breakthrough drug approval. In public markets, holding exposure to industries like genomics or nuclear fusion may serve a similar role. Great investors don't just think in probabilities. They operationalize those probabilities using a suite of practical tools that bring structure to uncertainty. Scenario analysis allows them to frame a range of possible outcomes, teasing apart the drivers behind each path. Monte Carlo simulations take this a step further by modeling thousands of potential outcomes, each based on varying inputs, to stress test core assumptions and reveal the distribution of risks. Reverse discounted cash flow models, or reverse DCFs, are used to work backward from market prices to uncover what expectations are already baked in, an invaluable way to spot when consensus has gone too far. Decision trees help investors map out contingent outcomes, showing how different decisions or events can branch into divergent futures, while Bayesian frameworks provide a disciplined method for updating beliefs as new information arrives, avoiding the trap of anchoring to initial assumptions. None of these are academic flourishes. They are essential instruments in the probabilistic thinker's toolkit, tools that protect against overconfidence, force clarity of thought, and reveal hidden assumptions before the market does. Despite its power, probabilistic thinking often clashes with institutional and emotional constraints. Many investment committees demand consensus, penalize temporary underperformance, and struggle with abstract reasoning. Short-term incentives, quarterly bonuses, rankings, and AUM pressure favor batting average over slugging. Cognitively, the human mind resists ambiguity. We crave narratives and cause-effect certainty. This discomfort manifests in overconfidence, hindsight bias, and a reluctance to update beliefs. Cultivating a probabilistic mindset is not just about tools, it's a lifelong habit of mental discipline. Investors can learn a lot from domains like poker and sports betting, where edge is everything and variance is the rule. Journaling investment decisions, reasoning, and assumptions helps separate luck from skill. Studying near misses and false positives sharpens judgment. Most of all, embracing probabilities means embracing humility. Great investors aren't right more often, they are wrong more efficiently. In a world of uncertainty, the investor's edge lies not in clairvoyance, but in calibration. Probabilistic thinking anchors that edge. It teaches us to focus on process, embrace variance, and optimize for asymmetry. It rewards preparation over prediction and decision quality over outcome flukes. Warren Buffett said it best. Take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do. It's not perfect, but it is everything.